Eden Batisher here, your enrolled agent with Paramount Tax and Accounting, demystifying income taxes one question at a time. We're going to take a little break from tax deductions and credits this week and focus on some foundational items. Today, we will talk about how tax brackets work. I'm going to use PowerPoint to help answer the question, how do tax brackets work? Now, most people have heard about the different tax brackets. The idea that you could pay 24%, 32%, or 37% in taxes sounds a bit overwhelming, right? The good news is that these are what we call marginal tax brackets. These tax brackets are, in fact, quite different from the actual tax that you pay to the federal government. And to know how much tax you pay from year to year, you want to look for your effective tax, not your marginal tax. So, what are marginal tax brackets and how do they work? This slide shows the 2024 marginal tax brackets for the 4 filing types. Many people understandably presume that if they find their income on this table, then they know what their tax rate is. And that's both true and false. To see what I mean, let's look at a single person with an adjusted gross income, or AGI, of $200,000 and a married couple with an AGI of $400,000. So this slide shows that in these two situations, the taxpayers are in the 32% marginal tax bracket. And so I've zeroed out the 35th and 37% tax brackets respectively. And I've capped the 32% bracket at 200,000 and 400,000 respectively. Now, on the single person's first 11,000 of income and the couple's first 22,000 of income, they each pay only 10% tax on that amount of money. So everyone in the United States pays 10% on this portion of their income at the first level. Here you can see the totals for this first portion of income. Now, for the single person making from $11,001 to $44,725, and for the married couple making from $22,001 to $89,450, they're only going to actually pay a little more, and only on the portion of their income that is at the second level. Okay? It's important to understand that they still only pay 10% on the first portion, and then only 12% on the second portion. All right, so now you can see the total tax on the second portion of income in each instance. And this continues. So for the third portion of income in both situations, the tax jumps quite a bit to 22%. This is the biggest jump in the table. This results in a big jump in the amount of tax owed. Again, everyone in the United States who makes over $44,725 if single, or over $89,450 for married filing jointly, pay 22%, but only on the portion of income that is at the third level. They still pay 10% on the portion at the first level and 12% on the portion at the second level. And you can see the amount of tax they pay on this portion of income at the fourth level. Now, before we go to the next slide, I want to remind everyone that the next level is the last because of the AGI I selected for these situations. The fifth level continues quite a bit higher than the numbers we have now. And voila, we have the last tax amount in each situation for this final portion of their income. And since there are no portions of income at the higher levels, the tax owed from those levels is also zero. And so now to find out how much tax someone owes, we simply add up the tax on each portion of income. So now we have totals, but even these aren't quite right. If you watched our previous video about deductions versus credits, I briefly mentioned that the standard deduction and how it takes that deduction off the portion of your income that is taxed at the highest rate. This is the deduction to which all US taxpayers are entitled. It's $14,600 for people filing singly and $29,200 for those who are married filing jointly in 2024. So now let's go back and take a look at the impact of this deduction. So now we're back to seeing the portion of income that we originally had taxed at 32%. But this is the portion of income where the deduction is taken. So the 200,000 and 400,000 are each reduced by the deduction. And now we have even smaller amounts of income taxed at the highest rate. And quite often, these deductions can actually move you down a tax bracket. Now we can see that the amount of tax they pay on the highest portion of the income has been slashed quite dramatically, in this case, divided by about 5. So the standard deduction dropped the tax owed from $42,832 for singles to $38,160, which is a difference of almost $5,000. And for those married filing jointly, the tax owed decreased from $85,664 to $76,320, or a difference of just over $9,000. So while the AGI in these two contexts were 200,000 and 400,000, and they were in the 32% marginal tax bracket, the percent tax they actually paid was only 19.08%. And that presumed no other deductions or credits besides the standard. If they were able to take advantage of other deductions or itemize, they likely would have dropped out of the 32% tax bracket altogether down to 24. And if they had credits to take advantage of, such as those we touched on last week or will hit again next week, their effective tax rate may have dropped still more. So in conclusion, your marginal tax bracket is just the rate at which only the top portion of your income is taxed. But remember, this is not your effective tax rate. Your effective tax rate is the actual rate of tax you pay across your whole income, taking into account deductions and credits. This typically is much smaller than your marginal tax bracket. So don't get caught up in your marginal tax bracket. Focus on the effective tax. So I hope this helped explain how the tax brackets work and the difference between your marginal and effective tax rate. As always, please post any questions or comments you have in the chat below and pass this information on to any friends, colleagues, or clients whom you think it will help. In the meantime, I hope you have a wonderful day. Thank you.